Welcome to the huddle for today, July 15th, 2021. My name is Bob Simpson, Vice President, Portfolio Strategy for Wealth Stewards, and I'm your host for this series of webinars. Today's focus is on financial performance of financial markets for the second quarter of 2021, and we're here to discuss performance of our investment models and how they affect your portfolio performance. Joining me today is Paul Tyers, Managing Director of Wealth Stewards and Portfolio Manager.
Good afternoon, Bob.
This is your investment review for Q2 2021. Please note that this is a review of our portfolios and performance for a relatively short period of time, and it's a very specific period of time, and that none of the information that is in this presentation is a recommendation of any of the securities discussed. Please consult your wealth advisor or advisor at the firm of your choice before implementing any trades in your portfolio. Performance of your personal portfolio may differ from the numbers stated in this presentation, as there are a number of factors that affect individual portfolios, such as fees related to the size of your portfolio, related transaction costs, and the timing of transactions. On today's agenda, we're going to look at Q2 and we're going to look at the first 6 months of 2021. We're going to, as we usually do, rate our strategies, and then we're going to also look at Q2 and 6-month performance. So let's dive in and let's take a look at financial markets for the first 6 months of 2021. Many of us are now double vaccinated, and we hope that COVID-19 is in the rearview mirror, but it's still a major factor until we have exited the pandemic, that borders have reopened, and then we get back to more of a normal life. When we looked at this last, the cases were spiking higher. So when we looked at it last quarter, but due to vaccines, we've really knocked down the number of new cases from 5 digits back to 3 digits. And there are only 467 new cases in Canada on a daily basis, which represents a dramatic improvement in that. Looking at vaccination rates are almost 70% single dose and 43% double dose in Canada. And we've really caught the US really quite quickly in that regard.
As you can readily see, US equity markets continued strong through Q2, with the S&P 500 generating a total return of 12% in Canadian dollars year to date. Canada, which normally lags the S&P, outperformed during this period. Now let's pull back the curtain and take a look at what happened in each of these markets. The chart on the left shows earnings growth for the S&P 500, which is a good benchmark for the US large company economy. There was a small dip due to COVID, but earnings appear to be back on track to solid earnings growth. Since earnings is the major factor that drives stock prices, we should continue to have a good stock market until earnings start to flatten out or roll over into a new phase. One question that we're often asked is, are the markets expensive now? And the chart on the right shows that the price earnings ratio are fairly normal at 44 times earnings. This is a little higher than the average of 37 times earnings for the period back to January 1st, 2002, but it's not excessive when earnings are anticipated to grow strongly in the short run. For those who have followed our individual equity strategy, you've probably heard that we look for companies with consistent and predictable earnings growth, where it's expected to continue and where we can buy these companies at reasonable prices. We'll show you shortly these metrics on our current holdings. So we don't think we're in an overvaluation bubble at the present time. As most people will appreciate, the Canadian and US markets have a very different makeup. The TSX Composite is weighted over 30% in financial services versus 14% for the S&P 500. It's weighted almost 13% in energy versus under 3% in the US market. And it's weighted 11.5% in technology versus 24.5% for technology in the US. Since the COVID shock, energy stocks were hit hard and the bank stocks followed. Oil prices have recovered well since then. And so both sectors have recovered fairly well, but they've been playing catch up in the first part of this year. We don't think this trend on energy stocks is sustainable, and we do think that US stocks will get back on track to outperformance, largely in part to the technology slant compared to the TSX.
One problem that Canadian investors have experienced is that when stocks go up, the Canadian dollar often follows. Canadian investor portfolios and their performance is often poorer than that of the United States investors when we have a strong Canadian dollar as a performance headwind. When markets drop, so does the Canadian dollar. So when markets drop, the Canadian dollar acts as a parachute, which can soften the blow and help to hold the value of your portfolio higher. So we underperform in good markets and we outperform in down markets, but over time, the Canadian dollar goes sideways. So there's very little change. As most of you are longer term investors, there may be some short-term pain when the Canadian dollar rises, and that's what we've experienced since March of last year, but that's not often sustainable. Through the end of June, the Canadian dollar was up 2.38%, which is well off its highest levels that we've experienced in this current run up in the Canadian dollar. Now, last quarter, we talked about how we were keeping a close eye on longer term interest rates in the United States, which had charged higher, and we were watching the 2% range as a possible trouble spot for stocks. But as you can see by these charts, rates kind of hit a brick wall in the 1.5 range and have come down, which has helped our portfolio values in the last couple of months as the Canadian dollar has declined. Now, in each of our reviews, we like to rate our individual strategies so that you can get a peek behind the curtain. Our goal when we manage strategies is to generate a return that we feel is acceptable for the particular type of investments that we have. So equities, over time, we're looking for higher returns. Some of the strategies like our fixed income investments, we're looking for much lower returns, but more steady returns. This slide graphically represents and displays our North American individual strategy. Number one, it contains household names, companies like Adobe, MasterCard, and Google. Number two, it is well diversified by sector, but it avoids the cyclical sectors like energy, mining, utilities. Utilities are really a bond equivalent investment, and we already have that in our portfolio. And we exclude real estate because we cover that off in a completely different portfolio component. Now, they have returned on average 23%. The holdings in our model have returned 23.25% per year over the last 10 years. This demonstrates the longer term strength of these companies. So if you'd invested in this basket of companies, you would have had a 23% return each year for the last 10 years. Earnings growth, which is the major driver of stock performance, is expected to grow on average from 13.16 per share to 21.46 cents per share. That's an increase of almost 63% over the next 2 years. So if these companies did experience this earnings growth that the analysts are calling for, that should result in very high returns over the next couple of years. Now, on average, these companies are trading at 37.65 times earnings. The 5-year average on these companies is 42.82. So we're trading at a significant discount. So when people say, is the market expensive? Well, some things are expensive, but the holdings that we have in this particular strategy right now are trading at a significant discount to their 5-year average valuation. On average, these stocks rose a strong 16.55% in the first 6 months of 2021. So that gives you a pretty good picture of how this portfolio performs. Now, this is a simple way for us to demonstrate our stock selection system. As portfolio managers, we work to stay disciplined and to get it right the first time so we can minimize portfolio turnover, which results in transaction costs. And we try to avoid that to keep the costs of running your portfolio low. Now, during Q2, we did a couple of trades. We sold Medtronic, which we bought back in, call it April, May, shortly after the COVID meltdown, and we did very well in that particular stock. But we switched that into an ETF, the iShares Medical Device ETF, of which Medtronic is a holding. It has outperformed Medtronic over time and tends to drop less in bad markets due to ETFs have more holdings, therefore it's more diversified. Now, we actually doubled up our position in Q2 in this particular ETF to bring our healthcare position up to target weight. Now, this is the kind of trade that we like to do. We want to improve potential upside while reducing portfolio risk. We don't see this opportunity often, but since our purchase of the ETF, we've doubled the performance of Medtronic over that period. So it's turned out well in the short term. Now, on the other hand, we purchased a company called Ball Corp, which is a packaging company, which was on a dip, but unfortunately continued to dip, and it was down just under 9% from our purchase price. But in Q3, it is recovering and it's getting back to the level we paid for. So again, we like the company, we like the numbers. It's just in the short term isn't working out the way that we had planned. Before fees and currency, the North American strategy generated a return of 15.98% based on our model. During the first 6 months, we'd have to rate this an A. We believe that it's done very well. It actually outperformed the S&P 500 and slightly underperformed the TSX Composite, which we discussed earlier, we believe is unsustainable. So we really target the S&P 500 normally when we're doing our valuations. Now let's take a look at what we call our global and specialty manager strategy, which is a strategy that we developed that is made up of a broad range of investment managers managing our mandate. The numbers on the screen reflect the current returns over a variety of time periods for our holdings in the sector and specialty manager strategy. Although changes have been taking place over time, this is a good approximation of a typical portfolio held by most of our clients. During the first 6 months, we eliminated the Pender Small Cap Fund in March. We felt that it actually performed really well, but the volatility was very high and the quality of companies we thought was quite low. So we eliminated that. On the other side of the page was the BMO Low Volatility Fund, which, and now that was a US holding, and it really wasn't performing. It hadn't returned much at all over the last 6 months. So we decided to move on from there. And this is a much better representation of the funds that we currently hold. Our specialty and sector manager strategy produced a 9.78% return before fees for the first 6 months of 2021, which is slightly behind the S&P 500 total return in Canadian dollars. And it's well behind the TSX Composite, but 10% for 6 months is higher than our normal equity target for a full year. So we'd score this a B. Not quite as good as the individual stock strategy, but still performing well based on our targets for equity strategies. Next, let's take a look at real estate. The real estate model has performed very well in the first half of 2021, returning 10.4% for the first 6 months. It did lag quite a bit. And in previous quarterly reports, we rated it a D. It has recovered very, very well this year, returning 10.4%. We believe that's a high B, low A for the type of return. We don't expect 10% year over year in this. We're targeting somewhere in the 8 to 9% range. So we have exceeded our annual target in the first 6 months of this year.
So overall, how has our equity strategy performed? Well, it's made up of a North American growth strategy. The fund strategy and the real estate strategy has performed well in 2021, turning in a return of 10.5% before the currency effect somewhere in the 1.5% range, as much of our portfolios were in US dollars, and of course before fees, which vary by client. Now let's turn our minds to the fixed income and private debt category. It's usually a part of the portfolio that provides slow and steady return through a combination of regular income stream. And although this continues, it's an area that we want to make you aware of some of the changes that were made. As discussed previously, Wealth Stewards has been a leader in making these investments available to clients. And we think it's worked out well at a time when bond yields and GICs have fallen to less than 1%. And it's through an initiative that broadly is called Be the Bank. Not beat the bank, but be the bank. You see, in my years in banking, the banks were very good as deposit gathering entities. And so they would take your deposit out at as low rates as possible. And then they would lend those monies out for personal loans, mortgages, and even credit cards, or to corporations needing funding. See, private debt provides a way for clients to be the bank and to lend money effectively to the same group that the banks did, except the individual gets the yield rather than the bank getting the yield. For example, Antrim, that we use fairly widely, it lends money in the form of personal high equity mortgages. Trez lends to commercial borrowers, and Cortland Credit loans money against some of the highest quality corporate receivables are available. In this way, you get to be the bank. And we think it's a very positive development and one that will continue for the longer run. Now, one of the challenges in this area, however, and we mentioned earlier that Wealth Stewards was early to this development. We're now experienced that some of the funds that we've been investing in have been discovered by more and more investors. So in March, one of the managers told us that they received 5 times the normal investor inflow of funds. Unfortunately, the borrower demand didn't keep up with the lender demand. The manager ended up holding too much cash, which of course is a drag on the portfolio. We do believe, and it's already proven out, that this was a short-term problem, but we did in the short run see rates on the private debt about 1% lower than we had experienced previously. Now, we're not talking about putting capital at risk here. We're talking about things that are fairly vanilla, things that the banks would also lend to. But again, we're allowing this to accrue to our individual investors. And we've also checked with our private debt managers, and the problem of having too much liquidity is correcting itself, so we should see improved returns in the near future. So let's look at the returns, and we can see here that the returns on the private debt have returned 2.83% for the first 6 months this year, which is slightly below our expectation of 3%, but it's considerably better than holding a traditional bond portfolio, with the proxy for which is a bond ETF, and that lost 3.63% in the first 6 months this year as yields bounced off the bottom and moved to a higher level. We think one of the clear benefits of our strategy of private debt is eliminating some of the volatility that has been seen in the bond market and is exacerbated when interest rates are particularly at the low levels that they're at currently. So let's have a look at the individual holdings that we're using for private debt. You're going to see some new names in here because we're continually looking for opportunities for further diversification and better yields, of course. You can see that in the 6-month category, overall, the returns average 3.79%, as I mentioned, but there's some variability in the returns. The highest coming in with 9-point alternative income fund at 6.55%, and the lowest for the 6-month period of time at only a 0.7% amount. Clients who have been with Portfolio Stewards for quite some time will see the name Quest Productivity Media and CIP Alternative Income Fund. However, for newer clients, They won't see those holdings because we're utilizing 9 Point and NextEdge, which we've introduced in the last quarter. Why have we done that? Because you can see on the right-hand side in the bottom two categories, they've had returns of between 7 and 8% over the past 3 years. And we think that these are representative returns of what we'll see on a go-forward basis.
At the end of the day, all of our hard work boils down to this: the performance of our balance models. Because most people don't simply hold these individual strategies, they hold a combination of the strategies. Returns for 2021 have been strong in strong markets. Moderate growth should be the strongest, and moderate conservative should have the lowest return. In a weaker market, this will probably be reversed, as equities will underperform the more solid straight line kind of returns of the private debt and fixed income. Now, please remember that all the numbers that we've discussed today are numbers before fees, and they may differ quite a bit from individual portfolios that have money moving in and out of the portfolio. For a update of your personal return, please check with your Wealth Stewards advisor, and this will probably be discussed in your quarterly meetings with your advisor.
We want to thank everybody for listening to our Q2 review. And most of all, we want to thank you for the loyalty that you've shown throughout a rocky period since the beginning of 2020. We think that our strategy, changes that we've made are reflected in positive returns. And we just thank you for your patience. And we look forward to good results on an ongoing basis as we go forward. Having said that, none of us knows the future. And what we've tried to do overall is position your portfolios first with a view to protecting your capital, and second with a view to making reasonable returns. So we thank you so much again, and enjoy the rest of your summer.